All right, those are views across asset classes. Richard Harris is Chief Executive at Port Shelter Investment Management. He's joining us right now to take some questions. Richard, great to have you with us here. Thank you very much for your time.
Thank you.
I mean, bond yields are jumping, and central bank rate hike expectations are being repriced very aggressively. The US 10-year and 2-year went up over 30 basis points, 32 and 35 respectively last week. What will this do? I mean, so fixed income is under pressure. What does this mean for equities?
Well, we had a pretty spectacular week last week, with the way the bond markets moved. But I think it really came about because the markets were thinking that the Fed might actually pull back their tightening bias because of Ukraine. Now, the Fed then came out and basically said that wasn't going to happen. So all the analysts had come down from, say, a 50 basis points rise, came back down to 25. And then last week, they went back up to 50 again. I think the reaction in the equity market has been maybe a little bit perverse, but then maybe not. I think the equity market's saying, we did, if you look at the end of last year, have a pretty overblown market. There was irrational exuberance around. The market went up until January the 2nd, and then it fell pretty solidly from there. So at least it's come back a little bit more towards intrinsic value. And I think the markets have sort of felt that, well, if the Fed is going to have some sort of control over inflation, or at least going that way, if they are going to have some sort of control of the economy, then the economy seems reasonably strong in terms of numbers. Well, let's price equities up again. So we're in a position where the markets actually have done quite well, which maybe goes back to the old adage that sometimes war isn't so bad for equity markets.
Okay, Richard, hi, good morning. Actually, you literally stole my next question. But in some sense, then, is the market also pricing in the end of the war? I mean, is geopolitics now going to remain perhaps less of a cue, and the Fed action going to be bigger cue going forward?
Well, that's really interesting, because what we're looking at now is market narratives. We've had a month of war in Ukraine. The Russians haven't been able to roll over the Ukrainians. The Ukrainians have stopped them, and we now seem to be approaching more of a stalemate. Now, as that happens, as there are no surprises, I think the market will start looking back towards more fundamentals, or at least the irrational fundamentals they were looking at before, where liquidity was driving markets, where positivism was driving markets, where the markets were recovering from COVID. So these stories are now coming back in, and the war in the Ukraine will remain pretty well bubbling away until there's new news. Now, if the Russians start being more aggressive, both in terms of conventional and non-conventional weapons, then, of course, all bets are off the table. If there's a ceasefire, all bets are off the table. The market's probably betting on some kind of ceasefire coming through. So I think they've got that bias at the moment, which is why they're looking on the strong side. So in answer to your question, I think basically markets are saying, yes, we know about what's happening in Ukraine. We kind of get the narrative. We can put that on the back burner now and look at other factors.
Okay. Richard, hi, good morning. It's interesting you say that wars in hindsight rarely have any impact on equity markets, because our own market, India, has been so resilient despite crude at, $119 a barrel, despite inflation at the highest we've seen in many, many years, despite a war situation. Our market has not even fallen 1% this year. That speaks a lot about how resilient it is. You think that's something that can continue?
Well, I think what the market is looking for is, it's not looking at $117 oil. It's looking back at below 100. If there's a ceasefire, that's what's likely to happen, because there's obviously a lot of premium in oil prices at the moment, even if the West doesn't roll back the sanctions as maybe Russia would like, quite as fast as they would like. So I think the market is taking an optimistic view on what's happening. It's probably not an unrealistic view in terms of what might happen in the future, because I think Russia has bitten off rather more than it can chew in Ukraine. And clearly all Putin's done is range a lot of concerted opposition against him now. And that's quite serious. But both sides have to declare victory. Russia probably more than most. But there probably is a form of words out there that they will be able to do that.
Richard, at some level, from the rate hike sort of point of view, it's almost about what you make of the people running the Fed right now. Some say, well, I mean, they're not Walker and Company and what they did in the 70s, right? Raised rates aggressively, caused a recession, but brought things under control, right? This is not the same Fed, and they won't do it. Although they are telling us that they will, they're prepared to do what it takes. What's your thought on this?
Well, my thought is it's a pity we aren't back with the grown-ups, you know, with Volcker in charge, because he was able to do something against political mood at the time. He really had the charisma. He had the, should we say, the determination to put through policies that were unpopular. But also the politicians were happy to let him go along with that too. So you've got to give credit to people like Reagan who were able to do that. Unfortunately, this Fed has proved itself to be really rather spineless. They should have increased rates when they could. They should have fixed the roof when they were able to, when the sun was shining. So rates should already be much higher than they are now, but the Fed was terrified it may spook the markets. Sooner or later, the markets are going to be spooked. You have to really bite the bullet on that. But I think that we are seeing a Fed now that if it gets into the groove of raising, it may well do that. And it may well feel that as inflation starts moving towards the 7, 8, 9%, that it can't have interest rates at the 2%. Okay. So they're going to be in a bind as well. And if inflation does go high, sooner or later, inflation alone will cause a recession. And then the Fed won't be blamed. So I think the Fed is relatively spineless, but I think they're in a position where they have to raise rates. They're so far away from the benchmark that they have to do it. And I think the markets have taken it in a rather mature and positive way.
You know, the Fed may not be alone here, right, Richard? A lot of people believe that a lot of central banks have been behind the curve. Even here in India, a lot of people believe that, you know, the RBI is well behind the curve, which has normally not been the case. But anyway, that's, of course, a completely different debate. Now, the other interesting issue is that what about the profile of stocks? Because the sense you get looking at the market is the market willing to move from technology to economy-facing stocks, to banking, to financials. You think that's something which could play out this year?
I'm not sure if that's a firm move. I think as we see recovery, of course, we're going to see recovery in those kind of cyclicals and financials. But if you're an investor who likes to look ahead 6 months, I still think you still have to look at the kind of trends that were doing well previously. Tech was doing well previously. We're probably going to see farmers do quite well. If we see inflation go up, there will be winners and losers. And the winners will probably be companies with low ticket items that can put, you know, a few pennies on the prices of their goods. People won't really notice it and they can keep pace with inflation. So I think that we are reaching a new paradigm of investment. Yes, you still have to keep your weighting in the banks because often they're a very big proportion of the economy anyway. But you also have to keep in mind that they're the ones who'll take the non-performing loans on the nose. Big single ticket items may be quite in some trouble because you're likely to have people not willing to spend quite so much if we see inflation go up and belts being tightened. But I think the equity markets are still interesting to be in. Many equities can keep pace with inflation. It's really going to be an active buyer's market rather than just looking passively at the indices.
So one final question, just to summarize what you've been saying, is this a good time to be putting money to work, especially in markets like India?
I'm not so sure you want to have more money in the market. Now, I think many investors will be quite heavily weighted in the equity markets because they've done so well, even if you've done nothing. Basically, all you had to sit on your positions. I'm not sure I'd be putting money to work at the moment unless it was new money. I've been saying for a long time that you really do want to stay out of the bond market because you're not hiding to nothing because rates are going to go up. But the equity markets are a bit of a conundrum. But always remember that if the bond markets really fall out of bed, the equity markets won't be able to resist. So if we are seeing maybe the hints of recession further down the line because inflation's too high, then of course the equity markets won't be able to hold out. But at the moment, it's so far so good. Hold on what you've got. Maybe take some profits if you've got some big profits. But I wouldn't necessarily be putting more money in of the market at the moment.
Okay, we got that. Thanks a lot, Richard, for joining us as always. So hold on to what you got. These are tough times, but don't put any fresh money to work in this market. We'll slip into a quick break. Our list of top 10 stocks lined up in just minutes from now. Stay tuned.